afternoon, dear all. My name is Xenia Dmitrieva, International Business Developer at Cbonds, and it is a great pleasure for me today to welcome you on the second chapter of our webinar cycle, which is dedicated to the search for interesting investment ideas in the bond markets all over the world. In our first session, we dived into the opportunities and dynamics on the Asian bond market. For those who lost it, feel free to check it out on our YouTube channel, Cbonds Global. This time, we turn our spotlight to a region of growing strategic significance, the Middle East and North Africa, or the MENA region. For Cbonds, this region also means a lot, since our legal entity is located in Dubai, where we also host our annual conference. And moreover, the UAE is among the top 5 countries where our clients are located. And I personally really love this sunny country. Our session will feature 3 outstanding speakers today, each bringing deep expertise in fixed income strategy, regional economics, and portfolio positioning. Together, we will unpack what is happening in the MENA bond space. Please meet Dr. Christopher Payne, Chief Economist at Knight Frank MENA, Mr. Manish Khilnani, Head of Treasury and Investments at Tech Capital, and my colleague, Mr. Max Zenkov, Deputy Head of Emerging Market Fixed Income at Cbonds. Good afternoon, dear gentlemen.
Hello, good afternoon.
Hi. Dear participants, as always, feel free to leave your questions in the Q&A box. In the very end, we will discuss the most interesting of them. Now, why MENA and why now? Because whether you are a global investor searching for yield, a regional institution managing long-term capital, or simply an observer trying to decode shifting macroeconomic winds, the MENA bond landscape is impossible to ignore. So our first speaker, Dr. Chris, will unlock opportunities in the sovereign sector of the UAE and KSA, also providing a macroeconomic backdrop. So Chris, you are very welcome. The floor is yours.
Hello again, everyone. Good afternoon. My name is Chris Payne, and I am the partner and chief economist for the MENA region for Knight Frank. And I'm talking to you today from Riyadh, which is where I am based. Knight Frank is, I'll say a little about Knight Frank is a consulting, it's a real estate advisory and consulting firm. We have offices all over the world, as you can see from our map. We're 125 years old. And in the region, we have offices in Dubai, Riyadh, Jeddah, and Bahrain, and Qatar as well in Doha. And we offer a large range of advisory and consulting services across the real estate landscape that you can see. I've been with Knight Frank a year. I have been in the Gulf almost 11 years. I've worked in Kuwait, in Dubai, where I was chief economic advisor to the governor of the DIFC, the Dubai International Financial Centre, and also worked setting up a REIT. So 11 years in the Gulf and the last 2.5 years in Riyadh. So obviously you may be thinking, well, why real estate in a call like this? But we at Knight Frank, we actually watch fixed income markets and particularly sovereign debt markets quite closely, as it is the kind of core from which we look at and value some of the assets across the region and obviously assess risk. And many of our clients are investors. Well, we have investors, we have developers, and of course, looking at the macro environment is all important as part of their decision-making process. So today, I'm going to introduce for those who don't know the region so well, I'm actually going to focus on the Gulf, the GCC countries, rather than the broader MENA region. So I'll say a little bit about the GCC and what it is for those who don't know. And then we'll talk about the Saudi sovereign issuances, UAE sovereign issuances, and talk about some of the sort of factors behind what's going on there, the depth of the market, and spreads and pricing. And then really, because I'm an economist, I'm going to talk about all things economics, which includes fiscal considerations as to what's going on in the bond markets at the moment. And then finish off by talking about just talking a little bit about so-called municipals. When I talk about UAE municipals, I'm actually talking about Dubai and Abu Dhabi, the Emirates of, that also issue debt. In fact, have issued more debt over the years than the UAE as a federal government. I'll say a little bit about that and the structure of those issuances when I get there. I should say municipal. Are they municipals or are they sovereigns? It happens actually that Cbonds itself classifies them as municipals, but they're definitely not corporates. That we all can agree on. So the GCC, the Gulf Cooperation Council, is essentially made up of these six countries in the Gulf. We've got a combined population of about 56 million people, of which Saudi is the largest, significantly about two-thirds, I guess, roughly speaking, of the population, like 32 million. Saudi's GDP is again the biggest in region. It's about $1 trillion. UAE about a half that. And obviously, oil production is very critical in these countries, and that gives you a sense of oil production barrels per day on the left-hand chart. Saudi is obviously the biggest producer in the region by some margin. And even when you introduce gas, obviously that massively increases Qatar's role in hydrocarbons when we include gas as well. But that is the region as a whole. It's fundamentally a sort of intergovernmental body, but there are aspects of it being a customs union as well. That's the GCC. So let me move on and talk about Saudi Arabia and UAE sovereigns. And you can see that there aren't that many issuances. I think that's probably the history. Now, on the left-hand side here, we can see that on the green line, this is Saudi Arabia, and on the little blue line is UAE, and I hope you both can see, everyone can see that. Now you can see there's 43 outstanding sovereign bonds issued by the Ministry of Investment of Saudi Arabia, and the UAE federal government has about, I think there are 13. And you can see historically, the UAE federal level only started issuing debt late in 2021, whereas the issuances of the recent round of issuances of Saudi Arabia go back to sort of 2016, and I'll talk about where that comes from. On the right-hand side, all these charts are obviously they're screenshots from Cbonds. On the right-hand side, you can see this is essentially the maturity. These are all the Saudi outstanding sovereign bonds by maturity. You can see that there's a very big gap between 10 and 20 years, which is why we don't have an index. There isn't an index for like a 10-year. There isn't a generic index for 10-year. And with UAE, you can see there are very few bonds. So there's, again, this is a kind of yoker, but there isn't, there's no real generic bonds there. You have to sort of work it out yourself, and you can see the gaps of maturity. Let's look at the yields of these. Now, obviously, Saudi's yields fell, along with the rest of interest rates around the rest of the world. We had the spike during COVID, and then you can see that really from when UAE started issuing its first federal bonds, you can see that they're very highly correlated with Saudi ones, slightly lower yield, but that yield has expanded over time. And the spread between the two, I should say, has expanded over time, and probably is at one of the larger points we are now. Probably an easier way to see that and start to tell you about what's going on is this chart. Now, this is the spread of KSA and UAE sovereigns over US treasuries. Now, this is, again, it isn't a 10-year because we don't have an index for 10-year in either sovereign nations. What Cbonds actually provides is an index of the yields of anything over 1 year in maturity and over $500 million in issuance. So it's a kind of weighted average index of its own, but it's not a specific maturity. But you can see that if we got the Saudi bonds in green, we've got UAE in blue. And actually, the spread over US Treasury was very aligned in this period here, and then has started to spread. So obviously there's a greater spread for Saudi treasuries, Saudi government bonds, Saudi sovereigns, and then over treasuries, US treasuries, then UAE bonds over US treasuries. And this spread has widened. And actually, this year in 2025 has got significantly wider. Why? Well, it's really all related to this red line, which many of you will have guessed is the oil price. And you can see when oil prices were very high after the initial sort of COVID recovery, we had this period of very high oil prices, then no one was really looking at the fiscal situation or differentiating the fiscal situation, either Saudi and the UAE. But as oil prices have fallen back down, so let's say they were averaging over 2023 and 2024, averaging, let's say, about $75 a barrel, you can see that that spread has widened. And as oil prices have come down in the last few months quite significantly, that is the further widening, if you like, of the spread over US Treasuries of the Saudi and UAE federal bonds, sovereign bonds. Now, why? And I think now I'm going to move on to this data is taken from the IMF and it gives you kind of a backdrop to what's going on. Now, actually so I'm going to start on the left-hand chart and I'm going to simply say that this is the fiscal balance, general government of the UAE and Saudi Arabia. And you can see that, what happened the last time oil prices fell was back at the end. There was a big collapse at the end of 2014 from about sort of $100 a barrel to sort of $40 a barrel, I think mid 2015. And that caused significant fiscal stress across the whole of the Gulf, particularly in Saudi Arabia as opposed to the UAE. And it was really in this point of time, if you look on the right, that obviously Saudi's debt program really began as they went through this period of high deficits. Arguably the same, even though the UAE wasn't in such a situation, they were still running deficits, and we saw some increases in debt that peaked. Certainly, UAE debt to GDP peaked in 2020. Since then, and I think this is quite, we've seen sort of deficits return in 2023 and 2024 likely and beyond in Saudi, whereas that isn't the case in the UAE. I'll talk about a bit more about that in a moment. But you can see from around 23 onwards the stability of UAE's debt to GDP. Whereas that is not necessarily the case for Saudi Arabia. And obviously that's sitting behind perhaps the differentiation we're seeing in the bond market, given spreads over US Treasuries. Why? I think this, we understand the fiscal deficit, but I think this probably sums it up most, this chart on the left, which is the fiscal break-even price. Again, sources the IMF in dollars per barrel. And you can see that there is quite a difference at the moment. I should say now the oil price here is the simple average of Brent crude, WTI, and Dubai Fata, these kind of standard measures of the oil price, different types. And you can see that both, so again, going back to 2014, both had very high fiscal break-evens. Saudi Arabia is approaching $110 per barrel, UAE at 90. And then when we had that previous period, both nations did a lot to actually control expenditure, bring it down, and implement fiscal austerity. And that's really UAE did more. They did a lot very quickly. And they both were quite successful in doing that. And if you look on the right-hand side, you can see that over time, they brought down expenditures. Saudi brought down expenditure as a percent of GDP, 40%, and has maintained it, at lower levels. UAE even lower, and I think that's where you see this difference. And both nations have increased the proportion of government revenue that comes from non-oil sources as well. I mean, a huge amount has been achieved when it comes to fiscal matters. And in fact, in Saudi Arabia, Vision 2030, many of you have heard about it, of course. But at the beginning, when it started in 2016, 2017, the headline was fiscal sustainability in Saudi Arabia. But obviously, as the kingdom has embarked on sort of that big diversification investment project, then you've seen more spending, and now, well, here you are, and this is fundamentally the difference that we're seeing. This is why, with oil price sitting the average actually of these three key benchmarks is sitting at about 67, 66, 67 today. So you can see that, UAE almost, you could almost say UAE has a fortress balance sheet, to use that kind of term. Saudi Arabia is obviously more exposed, and we are expecting a deficit of about 5% this year at that kind of level of about $67 a barrel, which is where we are pretty much today. So that's those two sovereigns in a nutshell. I will finish off by just saying a little bit about the municipals or Abu Dhabi and Dubai sovereign debt. And this gives you a sense. So this chart here, taken from data on Cbonds, I've actually put in the US. This is all the US Treasury issuances. It's essentially the yield curve of US Treasuries. And this gives you, you've got UAE and you've got Abu Dhabi. So the Abu Dhabi but the UAE is the orange line and sorry, I think it should, yeah, UAE is the orange line and Abu Dhabi is the blue line. You can actually see and actually Dubai is the yellow line. You actually see there are far more issuances from Dubai and Abu Dhabi than there are from the UAE. Now, interestingly enough, you see, the UAE only accounts, if you think about general government spending, so you're adding together federal with with all the Emirates, of which there are seven, then it's actually UAE only counts for 5% of general government spending at the federal level. It's actually it's a relatively small budget compared, and Abu Dhabi really is the biggest budget in terms of percentage of overall general government spending. Abu Dhabi, it covers a lot of the national security spending, and there are transfers to other Emirates, and there are actually transfers to the federal government as well. So in many respects, you can see that obviously there's very little market distinction between, on the yield curves of Abu Dhabi and UAE. It's kind of one and the same thing. And that shows up there. Dubai is here. I mean, Dubai have had, as I'm sure some of you were going back to 2010, have had some, concerns. But now actually there's still there's still obviously a spread over Abu Dhabi debt, but I think that has narrowed over time, and I think more people are very much more confident. In fact, Dubai have re paid back many of their Sukuk issuances over the years, and that there are only relatively few outstanding bonds. But it's interesting that now Saudi sovereign debt is obviously yields are higher than they are on Dubai, and obviously higher than they are in UAE. So that's where we stand. There, Dubai has its own, Dubai definitely has its own issuances and it has its own budget, but it's probably about the same size as the federal budget, which is about sort of maybe 5% of GDP. Federal budget is 5% of GDP. Abu Dhabi's budget is about 15% of GDP. So that gets you to the total somewhere near total general government expenditure of sort of just sub 30% of GDP in the UAE. So that's the difference between, and other Emirates do actually have some bond issuance as well. But here for now, I've just as a scene focused on Dubai and Abu Dhabi. Thank you very much for listening. And I think we'll come back, to questions at the end.
So, of course, dear participants, feel free to leave your questions in the Q&A section, and we will, of course, discuss all the interesting ideas and questions that you will ask us about. Okay, thank you, Chris. And
Thank you.
so, with the practical approach of how Cbonds platform could be used for, let's say, improval, for enhancement of your investigation. And no matter if you are focused on some long-term issuances or you are mostly like a private investors who are looking for some opportunistic, let's say, corporate issuances, Cbonds is the data platform that can provide this information. So as of now, let's check what is happening with the volumes in some of the MENA countries. So on the screen, you can actually see that I have opted for some countries of the MENA region. It is Egypt, Morocco, Saudi Arabia, and the UAE here. So we can actually see that Egypt and Morocco are re-entering Eurobond markets, and probably especially Morocco here is like these numbers are due to World Cup 2030. Also, as for Saudi, and Chris also mentioned it, the project named Vision 2030, and also other infrastructure and renewable energy projects. So we can also see large volumes of issuances here. And the UAE, of course, which can boast of their multiple thematic bonds that cater to ESG and Islamic investors, of course, with their sukuk issuances. So all of these numbers can be easily found on the Cbonds platform, which is a financial data source currently focusing not only on the fixed income market. So, however, the database comprises around 800,000 of bonds currently, with the coverage of 180 countries all over the world, and with the 100 percentage coverage for Eurobonds, as you can see right now. So to offer a holistic view of the market, we also go beyond bonds and integrate a wide spectrum of asset classes, including equities, ETFs, mutual funds, and of course market indices, so that you could also track the macroeconomic dynamics in different countries. So our services cater to a diverse client base, starting from institutional clients of different profiles, sectors, and industries, and ending with private investors and private consultants. We are also very proud to support clients in over 100 countries worldwide, as I mentioned, with the United Arab Emirates ranking among our top 5 user markets. And of course, it is very important to say that our platform is built to support you. And it is all starts with the tools that make your experience easy and effective. So here is the list of them, the core tools that are presented on our platform. So we have multifunctional screening tool for different assets, where you can efficiently filter and discover bonds, stocks, ETFs, and indices based on your custom criteria. Also, watch list, where you can track selected assets, monitor market movements, and stay informed with personalized alerts and updates. Also, notifications are available there. Mobile application for access the data and your watch list on the go. Excel add-in, which is a plugin actually which you install to your Excel program for custom analysis, modeling, and reporting with minimal effort. And of course, API and data feed solutions to integrate high quality bond data into your internal systems, platforms, maybe applications. So there are different use cases actually. Now let's take a look at some of them in action. So here is just like a particular use case. Let's say that you woke up in the morning and understood that you'd like to diversify your portfolio with some secure and, of course, liquid names issued in the MENA region. So Chris also mentioned some of them. Like sovereigns. So our bond screener will help you to, let's say, visualize these ideas, because you actually can specify all the countries that you need of the whole region, and find the most appealing opportunities in the market. So we now also have a currency specified here and liquidity indicator, so which have recently became available for issues of $500 million and larger, like in terms of the volume. So we got almost 50 results here, which are quite liquid on the MENA market. So let's also group them by issuer to see what is happening here. So even though we didn't choose a sector, it is visible that the government bonds and municipal bonds are very liquid on the MENA region. So, and we also see that Egypt hits the highest points here in terms of the yields. So it's It's obvious actually. So that's good. Let's also imagine that you got a risky mood today and you are looking for some unusual, let's say, experiments. So MENA offers a great opportunity to diversify your portfolio in terms of bond classes like ESG and Sukuks, for example. So say you decided to leave the same countries but interested in checking some ESG corporate positions, as there are different projects in the region dedicated to this topic, of course. So we see a lot of high yield positions with the yield starting from, I would say, 4 or starting from 4. And we can also add a benchmark, which could be US Treasuries, to see the spread between the ideas that we got and, of course, US Treasuries to analyze the risk. So you can easily visualize this information on the market map, or you can also download the issues that you got in Excel format to make your customizable calculations, for example, or again, depending on what exactly would you like to get according to these results. Of course, when you choose an appropriate issue that seems to be attractive for you, for sure you need to check like the latest quotes, prospectuses, and final terms. So let's say that you're interested in Abu Dhabi bond maturing on 2030, and you would like to check more information about this bond. So it's very easy to use the quick search, which is located at the very top, where you can insert the ISIN or the name of the issuer. So and here we go. The files are located at the very top in case you, of course, need to analyze these crucial documents like prospectuses and final terms. We have the largest database for prospectuses. Also, we store prices from around 400 primary sources, including stock exchanges and OTC participants, also covering intraday quotes, which are posted with 15 minutes delay, and end of the day quotes. As of now, you can see actually the chart. This is the price chart, the yield chart, sorry. We can also go to the price chart, and we can also add another issue, actually up to 3 issues here for comparison, to see the differences in price and yield for a particular period. So I have added a bond issued by Saudi Arabia to compare these 2 giants, actually. So in here you can see the changes in price at the different, let's say, time frames. So you can see this chart. Now, what else you can find on the very same page? We also store volume information on the very same page, cash flow parameters with the cash flow itself, which can be again downloaded, also the details on the placement, on identifiers. Moreover, we analyze these prospectuses and post covenants from them so that you could click on these links and easily get to the page that you require. Very convenient. Then, to check the appetite for a particular bond or a stock, you can check the holders section and see the ETFs which contain this issue in their structure. Also, you can check similar issues of the same maturity, of the same currency, or of the same industry. And of course, to check if the issuer is solid, the IFRS indicators, of course, which are also available again on the very same page. So you can download everything just by one click of your mouse. If you like this bond, if you think that this is the bond of your dreams, you can easily add it to your watch list. Also, insert the purchase price for a particular date in the past, the quantity, like how many, and then save it to your watch list to track it on a daily basis to see the delta, between the current value and the purchase price, and just like I would say, stay in line with the market. So now let's get a closer look to the watch list, which actually is designed to update you on different market trends. So as of now, you can see my watch list, which I have prepared before this webinar. I have made some groups here dedicated to Saudi Arabia and the UAE, of course. So I have inserted some purchase prices, and you can see that um, price change and yield change are marked there. So, and you can, of course, also turn on different corporate event notifications to stay updated regarding your watch list, regarding your portfolio, to know when is the next coupon payment, maybe defaults and etc. Because North Africa is not a very, let's say, simple region. And of course, price and yield alerts. This is to strike your best deal. So you can easily insert the price, you can insert the yield, and then as soon as this value reaches the number that you have inserted, you'll receive notification. So that's very simple. Here you can also store stocks, indices in case you track some macroeconomic indicators, maybe US Treasuries, maybe Dow Jones. Feel free to add everything to your watch list and stay in line with the market. And actually, since Middle East is the largest producer of sukuk bonds, Cbonds also made a separate tab for this type of issues for your quick access. So here you can check the latest sukuk issues, also the volumes, like in general. Also, you can check let's say the dynamics for a particular period. You can add other indices here for comparison again to see the gaps, to see the spreads, and etc. So everything is like it is and available on the same page. Of course, book runner leak table is available here. And actually, this tab also provides you with information on news in this Sukuk segment, and of course, latest issues issued by different like countries. You can also find this information here. So far, Cbonds has around, I would say not around, but over 4,000 bonds, Sukuk bonds in its database. And we also provide, let's say, a report dedicated to this special type of bonds. And I think that Max, my colleague, will also comment on it a bit later. So now the MENA region is actually no longer just an emergent story, let's say. It is considered to be a core chapter in the global fixed income market. So because of this sovereign stability, also energy-fueled growth and rising ESG issuance, everything is just like shaping a bond landscape, let's say, full of potential, but also complexity. So that is where we come in actually. Do not hesitate to give it a go and test your investment strategies with a 7-day free trial of our market data provider. Feel free to scan the QR codes that you can see right now on the screen. And let's actually have a direct chat to find the most appealing solution for your needs. So actually, I'm ending my presentation here. And now I'm pleased to hand it over to Manish Khilnani, who will take us deeper into corporate ideas in the MENA region. I'm sure that you have prepared something very interesting for us today as well. So the
Thank
floor.
you. Thanks, Xenia, for such an excellent overview of the Cbonds. We are actually dependent on that bond screener to identify opportunities. And I would also like to thank Chris for a fantastic overview to put together that GCC bond landscape. But I belong to an investment holding company and a family office. So I would rather be focused on investments straight up. Into investment, what you call is the high yield investments, right? Before I just give you, before I just get into the ideas, let me first introduce Tech Group. Tech Group is owned by His Highness Sheikh Rashid bin Humaid Al Nuaimi. He's a group chairman of Tech Group. He's also the chairman of Ajman Municipality and Planning. He's a member of Executive Council. He's the vice chairman of Ajman Bank. He's the chairman of Ajman Severage. Al Zora is a island development in Ajman, just like you have got Palm in Dubai. He's a former president for UAE football. So if UAE would have qualified for FIFA, he would be representing it. He's also the chairman of Ajman, Akar. and also a bunch of other board positions he holds in his government capacity. In his personal capacity, of course, he owns Tech Group. So we are a group of construction and building material company to remix precast blocks, wood, metalworks, foundations, and it's another 5-10 companies in our chem trade, tech petroleum, logistics, tech gulf, and properties. And we've got a bunch of JVs as well, including Varsan Waste Management, which is into waste to energy, which is the largest waste to energy company on the planet. We own Safi, Emirates RDF, Tech Agro, which is a agriculture company, and salmon farming in under ocean harvest. We have got hospitality assets under our hotels. All these hotels, which you're seeing, the chain of Ramada, Ibis, Sofitel on the Palm, the Retreat is are owned by our hotels. Then we have got 2 schools, City School Ajman, City American School Ajman, Kuka University, and almost like 6 or 7 shopping malls. These are the properties which have been under development under Emirates Properties. And notable ones include Dunia Tower on downtown, Azad Sofitel Residence in downtown, and some of the other projects. And we own multiple residential, commercial, and industrial assets under Tech Properties, including Tech Tower. Now I'll just straight up get into the investment ideas. So this is Manish Khilnani. I spearhead the treasury and investments for the Tech Group. Portion of profits from all these group companies are invested through our investment arm called Tech Capital, and some of the investments could work for people. Some investments might not work for people. These are solely my ideas and what we've identified. So on the MENA bonds front in UAE, I would first describe the broad investment rationale. The first one is, of course, we were looking at high single digit and double digit kind of returns. Then we were open to looking at high yield space, and therefore we could also look at the sub investment grade space within the GCC and broader MENA region. We were positive about the rate cuts before identifying these opportunities, which I'm going to talk about in next 1 to 2 years. Targeting higher coupons, and we are comfortable with duration risk if these are sovereign bonds. And our view for identifying these opportunities was max 3 to 4 year. So all the opportunities should basically be looked at from that mindset. First one I'm going to talk about is the corporate bond in the real estate sector, and we would want to take advantage of what's happening with the UAE, given the boom in the real estate in UAE. So there's a lot of inflow and influx of HNIs from Russia, India, China, Europe in UAE. 75% of them are cash buyers and only 25% mortgage buyers, which effectively mean things are not dependent on the credit lines extended by the banks. So there's a actual demand. A lot of reforms have happened in the UAE. So there's golden visa for 10 years, and that offers a lot of stability for residents coming in from all across the globe. There's a global instability, and therefore it has a safe haven appeal. So a lot of people, if there's a war situation, people actually look towards UAE to settling down. We only had a 29-day lockdown in UAE. So obviously it has shown such a demonstration on the COVID recovery front. It's USD pegged, so AD is pegged to USD. So any investment is pegged to USD, or so it acts like a natural inflation hedge as well. And a lot of developers here in the UAE have been doing a lot of innovation with, the branded residences like Bugatti, Mercedes, Armani, Dorchester. So it has a global appeal actually. It's a favorable tax environment, so there is no income tax, no capital gain tax, no withholding tax, no dividend distribution tax. Population-wise, Dubai is growing from 3.7 million to 5.8 million. And this is how Dubai is placed against other cities. With Hong Kong, almost 4 times of the prices in Dubai, and New York almost 2.8 times. So there is a lot of headroom for Dubai to grow in terms of the real estate, given the world-class infrastructure and the business environment here. So we are sticking to the large renowned corporates in the real estate sector. These are high yield opportunities. So obviously these are sub-investment grade. We're looking at shorter maturity, so we don't worry about, the movements on the prices on the bonds given the uncertainty around the yield front. So all these bonds which I've identified basically pay from 7.5 to 8%. And these are the top corporates actually. Omniat, Bingati, Shoba, and Arada. Arada is actually owned by the royal family of Sharjah, and there's a stake from the royal family of Saudi as well. But these are classified under the UAE corporate bonds because these are privately held companies. All these companies are quite robust in terms of their cash flows, in terms of the project pipeline, which is completely sold. And we are expecting, and these are all shorter maturities. If you look at it, Omniat would be like hardly 3 years, 2 years for Bingati. Shoba with the call option is just about 1 year, and a rather 4 years. So within 4 years, without worrying about the price movements, we're just locking in these YTMs. The next one is government of Sharjah. Sharjah is an emirate within the UAE, which is double B minus, but it is paying unusually high yield for being a sovereign, right? For a sovereign, it's an unusually high yield. We're talking about a very, very good risk profile. Sharjah is actually supported by the UAE federal government. So it's actually, institutionally stable, and it's de facto supported by the federal government of UAE here. It has a potential upside in terms of the capital gain. We're looking at a longer maturity here, of course, but we're talking about a 2 to 3 year view where the interest rates are going to come down, and there could be a potential gain on the bond prices. Given the way it is managed, the way it is diversifying today, in terms of opening up the real estate, growing the tourism and transportation and logistics sector, there is a potential rating upgrade possibility in the next 2 to 3 years. So that can help in increasing the upside. It is US denominated and there is no withholding tax, meaning a lot of Asian jurisdiction and other jurisdiction have these 15 to 20% withholding tax. So there is no withholding tax here. So whatever YTM you see is kind of a return to the investor, net return. It's a very popular GCC name, so there's a lot of interest from the local and regional investors. So it's highly liquid as an issue. It's a very defensive high yield play because it has got a low volatility compared to other counterparts. The next one is Arabian Centers of Saudi. We all know the kind of transformation Saudi is going through in terms of the infrastructure. Arabian Centers own a lot of large shopping malls. It's rebranded as Sinomi. This bond, which I picked up, is a very high rated bond of double B plus, just one notch below the investment grade, and offering an excellent YTM of 9.8%, which one can lock in today. So it's a very attractive credit for a low duration. It's hardly 1 year plus few months. We're talking about a double B plus credit, which is just one notch below the investment grade. There is a lot of asset recycling and deleveraging done in this company, so there could be a potential upgrade possibility. But of course, it's a 1.5 year issue, so we don't worry about that. It's a government supported sector, so there's a lot of support by the government for the retail and tourism and entertainment sectors, and this is a priority sector for them. So the companies here are obviously going to favor. It's Sharia compliant, so it's a sukuk. So there's a lot of demand within the regional investors for sukuk, and the country is actually improving a lot of fundamentals in terms of the infrastructure boom we are seeing, in terms of the non-oil diversification we are seeing for Saudi. So the Arabian centers would benefit from that, and it's a very good GCC diversification for a non-sovereign, non-oil sector. The next one is KIPCO. KIPCO is a large. It's again a corporate bond. KIPCO is a very large investment holding company of Kuwait, locking in a YTM of 9.24%. BB minus credit. It's a shorter duration, and it is a very strategic entity for Kuwait, which owns Burgan Bank, Camco Invest, which is a large asset management company. Burgan Bank being number 2 bank after National Bank of Kuwait in Kuwait. OSN, which is an entity which offers all these entertainment channels. If you look at the TV space, Equate Petroleum, which is a large petrochemicals company, JTC handling a lot of ports, and a large United Real Estate is basically owned by KIPCO, which is a large real estate development company of Kuwait. It's Kuwait based, so Kuwait is a very highly rated jurisdiction overall. So it with an absolute low sovereign risk. So KIPCO benefits from being in that jurisdiction. It's a very high yield exposure with low volatility. The next one I've got is Turkey, the Istanbul Metropolitan. This is a municipal bond, BB minus rated with a YTM of 8.27%. We are again talking about a shorter duration here. The rationale here is it's just over 3 years maturity. Istanbul Metropolitan Municipality is actually the largest and the wealthiest municipality of Turkey, managing over almost 15 million residents. They're controlling major infrastructure, transport, and urban development, and contribute almost 30% of the national GDP. So that spreads sometimes are quite tighter compared to even sovereign, so because of its better governance. It has an upside potential should there be an improvement on the interest rates, the credit outlook. Turkey, as we all know, has been reducing its debt to GDP ratio over last 3 to 4 years. So this could benefit in potential rating upgrade. We're talking about a diversification in terms of a municipality bond here. So if you want to make a portfolio, there's a high yield corporate bond, there's a sovereign, and then there is a municipality bond here. So it's a nice diversifier for the portfolio as well. Lastly, this is ultra high yield, and it's a hot favorite for the GCC investors here. Although because it offers such a high yield in terms of YTM is 12.25%. I'll tell you the rationale here. It is absolutely backed by IMF, and we've seen from last 2 to 3 years, IMF has been backing up Egypt, and not only just IMF, there is a huge investment from UAE and KSA. So in 2023 and 2024, we had seen a lot of volatility in this particular bond. However, UAE and KSA has always come to its rescue for all the bond payments because it's a strategic location for UAE as well from a geopolitical point of view. It is oversold and deeply discounted a long duration, so it could benefit from the convexity-driven upside, and there could be a ratings improvement as well because it got upgraded just last year. It's a good diversified emerging market exposure for the portfolio from a MENA perspective. While the GCC is highly rated, this is equally robust, and one could invest by having a little bit of a tactical play of coming in and going out by making some sort of a capital gain here because it's a long-term maturity we're talking about for the sovereign. With this, we get into more of an, like a diversified exposure from a non-oil sovereign, and there's a long-term return asymmetry which we're wanting to exploit for this particular bond, right? That's it. I mean, these are the kind of opportunities which we thought could be worth talking about for today's forum.
It was also a great pleasure to see a reference to Cbonds on each slide, so I also rely on this source.
Thank you.
So, yeah, thank you so much. Before we move on to the Q&A session, we have one more presentation, the last but not the least. So, which is prepared by the deputy head of our emerging market department, Max Zenkov. So, Max, I'm yielding the floor to you.
I will try to map some bond market trends using Cbonds instruments. We will approach the markets of MENA region from different perspectives with various tools which are given to the users of our platform. So let's start where everything begins. Let's take a look at the sovereign yield curves for the USD denominated bonds. And here, what we see, what was, of course, mentioned already, most of regional USD curves align quite closely with the US Treasury's curve, with a steeper trend and at the longer durations. While Egypt obviously having the rating which lies beneath the investment category, has far steeper upper band of the curve. But that's where the interesting part begins, because we need to explore. So what is behind this larger yield reward offered by the sovereign bonds of Egypt? So here I am taking the floor from Manish, of course. So let's take a look at the repayment schedule of Egypt's sovereign bonds, both international and local currency bonds. And what is striking here is that in 2026 and 2027, there are really large amounts due. And repayments alone constitute around 20% of the country's overall fiscal expenditure, which surely puts a financial strain on the repayment capabilities. But what also worth mentioning, and what was touched upon by Manish previously, is that actually the reform agenda in Egypt is yielding results. And what is worth noting here is the overall stable debt to GDP ratio. And also what we can derive from the graph is that the exposure to external borrowings is generally quite limited. So some resilience is here. And turning back to the broader regional picture, we can take a look at USD treasury spreads of regional countries. And here, what we can observe is a picture of resilience, because despite numerous shocks of different nature, starting from COVID-19 to reciprocal tariffs or Liberation Day, whatever you call it. So we can see that the yields are like retreating back to the more normal positions, in a quite rapid manner, generally. And even for Egypt, where of course T spreads are elevated, they are still far from the historical peaks now. And Also notably, Oman has demonstrated a considerable improvement in USDT spreads over the last 5 years, almost pairing with United Arab Emirates, getting really close in this sense. So let's continue our exploration by looking at the yearly changes in USD price indices calculated by Cbonds. I added some African countries as well for the sake of comparison. And here we observe uniform positive movement in sovereign bond prices in the region. Of course, Lebanon is a different league because it remains in default. Bonds trade low, but there is still a huge improvement over the year. And Egypt, Jordan, United Arab Emirates are demonstrating really strong performance in this sense, especially in the case of United Arab Emirates. It is notable because the lower yield level you have, the more hard-won is each percentage of price appreciation in your bonds. So let's move on to the corporate sector. And here we will take a look at the gainers and losers of in the Eurobonds of MENA region over this year. And the gainers list is quite diversified in terms of industries. Issuers from Kuwait, Qatar, and United Arab Emirates dominate. And here we can see that mostly instruments are maturing in 2027 to 2031. Which reflects the movements of US yields. Of course, also there are two perpetual notes here as well. But let's take a look at the top losers list. So here, what is striking is that the issuers are majorly linked to the energy sector in various manifestations, and these are predominantly longer-term securities. And taking a glimpse at the aggregate sectoral picture, we can see that the oil and gas extraction and refining industry over the year were not obviously in their best shape, while contrastingly, chemical and petrochemical industry bonds performed strongly, along with some other sectors like other financial institutions, banks performed decently. And of course, we cannot reflect on the regional bond market dynamics without a reference to the oil prices, which are of great importance, of course. And here I would like to present Cbonds consensus forecast tool, which is available for our subscribers. Here we can see that the consensus forecast published by Cbonds expects that there will be some rebound from the current lows in oil prices, but no return to the values over 75 or close to that are expected anytime soon. And finishing the corporate story, we should mention that the corporate investment grade USD T spreads experienced were stable, while in the high yield Eurobond segment, there is a tightening of spreads between regional high yield papers and US Treasuries, which possibly reflects a softening of region-specific risk sentiment on the part of global investors. And I would like to put a particular stress on this softening of region-specific risks come amid really turbulent global landscape and amid really turbulent years in the region itself. And wrapping it up, I would cover Cbonds platform instruments with a reference to MENA region one more time. We have a database of 4,500 active outstanding local debt securities. For example, in Egypt, our coverage is superior to other providers. We have 100% coverage in Eurobonds with 1,600 international bonds in our database for the region. 50 plus quote sources, macro data, corporate actions, ETF and funds if you prefer this type of investment product, and multiple regional research providers whose materials are available at our research hub for any user of the website, whether you are a subscriber or not. And just a final chord here. We also put a stress on Sukuk coverage, and we publish quarterly Sukuk report, which can be downloaded using the QR code at the page. And of course, apart from some generic and aggregate data on Sukuk issuance and league tables, we also provide some more specific characteristics like the type of Sukuk along with other parameters. And we also invite all experts to share their insights on the Sukuk market developments to contribute to our report. Thank you for your attention.
Okay, so now let's open the floor for your questions, dear participants. Firstly, I would like to also ask our dear speakers about some interesting things. So the first goes to Chris. Chris, please. Please answer to our question that we created with Max this afternoon. So, in the current scenario of USD, let's say relative weakening, do you lean towards international or local currency sovereign bonds? Or do you consider this merely as a short-term condition which doesn't require any major investment strategy adjustments?
Crikey. Well, thank you. Thank you for that question. So, I mean, I will start by saying that obviously in the region, let's just talk about the currency pegs in the region. I think that's probably a good place to start. I mean, they've been in place now for, now that's a good question. I think, since the 1980s, the current level, I think. And they're very sound. Now, I think there's one thing we'll say, but the UAE's current account break-even dollar price. Okay, so I talked about the fiscal break-even dollar price before, but obviously there's also a current account break-even dollar price. And actually, if memory serves me correctly, the UAE's is around about $40 a barrel. So that essentially means that given trade flows, which is predominantly exports, is very heavily oriented to oil for sure. But there's obviously remittances forms quite a large part of the current account as well. So what it would say is that the really, the UAE's currency is as solid and as fixed as you like. Okay, so that's the first thing. Saudi's as current account break even dollar price is currently about $75 to $80. So we might expect a small current account deficit this year. And that doesn't mean, of course, they've got $400 billion sitting in the central bank in reserve. So I don't think we need to worry in any way. And that doesn't include what the Public Investment Fund have, their sort of sovereign wealth fund. That's a totally different pot of money. But obviously they are importing a lot of capital goods at the moment. as a result of the investments that they're doing. So there is differences there. Now, in terms of obviously they're fixed. They're built. Their economies are built on that link to the US dollar. So that in itself, I don't consider that. Whether I believe that the US dollar will continue to weaken, I mean that's the $800 million question, isn't it? And I think we can sort of, I think what we probably it's more than $800 million, isn't it? It's like the $26 trillion question, perhaps. So I think, look, it's obvious that policy that Donald Trump prefers a weak US dollar. He feels that other currencies around the world have been manipulated, and that is part of his obsession with the trade deficit. I think everyone probably on this call understands that he considers a trade deficit to be a loss, whereas in fact some might see that the international flow of capital into the US is a massive gain. That's all perspective. Tariffs meant a weakening US dollar, and that was part of the plan. And other plans that have been put out there regarding even, swapping long-term US treasuries for 100-year US treasuries would also lead to a significantly weakening US dollar. But I think what we've seen over the last, I'm going to quote the Wall Street Journal here, Donald Trump nil, markets won. Okay. In the first round, fixed income won, didn't it? US Treasuries won, and no one wanted to see a repeat of the sort of trust moron premium applied to US Treasuries as well. So I think we've seen a walking back from those tariffs, and that at this stage would speak to dollar strength, I would suspect, as we kind of revert back to where we started. But who knows? You never see. You
Oh,
never know.
exactly. That's a great answer for such an unexpected question, actually, Chris. Thank you so much for commenting on this. And we also have another one for, I would say, Manish. So, could you please comment on what impact may the negative trend in oil price have on the bond market in the MENA region, like in general? What risks and possibly investment ideas does the situation create?
Well, it all depends on the break even, as Chris was mentioning in the presentation. It depends on the break even oil price. So if it goes below, then obviously it will start depleting the reserves of the countries, right? So then obviously the it will not have an immediate impact on the bond market as such. However, over a period of time or a longer period of time, if this sustains, then yes, there could be a potential impact on the prices because people will start asking for a higher risk premium. So obviously, the underlying prices might go up.
Okay, sounds good. Thank you so much again. And we have some questions from the audience, actually. So, firstly, how do the UAE and KSA Treasury bond yields correlate to GCC equity returns, if at all? So, you can respond one by one, for example, if you have ideas about this question. So, who would like to start?
Sorry, I missed out on the question. What was
Yeah,
it?
how do the UAE and KSA Treasury bond yields correlate to GCC equity returns, if at all? So this is the question that we received from our audience.
Chris, would you want to take that?
I'm trying to think. I try not to. We spend a lot of time following fixed income. I actually, to be fair, I spend a lot less time following equity markets. But I will say this. I mean, it is interesting. Is that I'll certainly talk about real estate, if I may. I mean, people. Honestly, the interest rates, the story of real estate, say, let's take in somewhere like Dubai. So I'm slightly changing the subject, if that's okay, but I will come back to equity markets. The story of real estate has really in Dubai been a function somewhat uncorrelated to interest rates in actual fact, because ultimately it's a story of arrivals and population. So Dubai's GDP itself, let's take Dubai, is there's very little productivity gain, or we haven't really seen that over the last 15 years or so. What we've tended to see in Dubai is strong periods of economic growth, just very correlated to increases in population and the workforce. And this in itself has tended to be quite correlated to global events, whether it be COVID, whether it be Arab Spring, whether it be, Ukraine. It's tended to boost the population, and the Dubai story has come alive again. And then you've seen lower amounts of real estate being delivered, which has been a reflection of poor periods in the kind of the previous 5 year period. So actually, as periods interest rates have risen in periods when real estate prices have been very high because of other factors related to the population. So and so the equity markets themselves, I mean, a lot of the stocks, a lot of the REIT stocks, have done, in the UAE, in Saudi, for instance, they did very well in the period sort of, as the economies recovered, have actually come off a bit. And a lot of the developer stocks in the UAE have tended to rise during periods of interest rates because the actual underlying real estate market is high. I myself, I mean, maybe Max would like to bring up some charts to sort of test that test that theory live. So I'll hand over to him if I may.
Okay.
I'm
Thanks.
actually in the process of preparing the charts, so if someone might take it for now, and I will return with the answer.
Yeah, we will send it. And actually, we have one more question from the audience. So, would you buy high yield bonds that are not rated but have credit enhancement properties instead, such as like default insurance? So, what do you think? I think Manish, it's more.
Yeah, maybe I may have
Yeah, now
some
it's your turn. Yeah.
comments. Yeah. Oh, well, it totally depends on the conviction of the investor and the experience of the underlying. So, for example, if it's a large development company in UAE or real estate one, and we already know that they have got huge developments and they're coming up some with some unrated bond, and this has been a local family name which is carrying a huge reputational risk, and they just cannot afford to default. So they will do everything, even if the cash flows or the fundamentals are not looking. I mean, if it's not rated, then obviously it's not rated, right? So you can't really predict, and the information may not be as much available. So it's an individual call by an investor. If it's And we also need to understand what kind of a default insurance we're talking about, how highly rated the insurance company is as well, and what kind of clauses do they have in terms of default. But I have a better idea instead. Um, Given, I mean, just to taking it back a little bit on the treasuries as well. Treasuries used to be risk free. We still call it risk free. In our university days, we used to study an equation for KPM, in which we were talking about risk free return. Risk free plus beta times the market risk premium. Today, people are actually asking for a risk premium on the risk free. Imagine if risk free is so high in terms of the yield, there are other high yield bonds as well, which are rated, which are offering a very good yield. Instead of looking at unrated in this time, at this point of time, you might end up looking at a high yield bond which is rated. Instead, go to some local banks who can take a call on these highly rated bonds and take a levered position if you want to really, amplify your returns to double digits, right? So if a local bank is comfortable with any name which is double B minus and is able to give you a 40-50% LTV against it, and if I have a high conviction on those names, I would rather just take that and take some leverage as well. And if I want to be a little bit more, what do you call is adventurous, and if I'm happy with the USD CHF kind of a risk, I might end up taking in CHF as a leverage, which is negligible at 1% or so, and jack up my returns, right? Instead of looking at a non-rated bonds, right? So this is my way of doing things.
Okay, sounds reasonable enough. Thank you so much, Manish, for commenting on this. So, and that's
Xenia,
actually, yeah,
I'm
Mike, go
finally
ahead.
ready to deliver an answer on the previous
Okay.
question. And
Wow.
actually, curiously enough, I calculated the correlation coefficient between S&P GCC Composite Price index tracking the performance of stocks, and Cbonds Saudi Arabia Sovereign USD YTM index, and theoretically they tend to move in inverse directions. But what I've got is 0.24 correlation coefficient, which is not which does not denote strong correlation at all, and the sign is positive. So to the contrary of usual situation and usual theoretical predictions, they tend to move in the same direction, albeit without strong correlation in place.
Thank you, Max, for this, I would say, amendment to the answer. So, and of course, Cbonds help you to understand that, right? So, okay. So now I think that's it. Dear colleagues, a big thank you for your thought-provoking contributions, and to all of our participants for joining us. So, hope you enjoyed the productive session we had today. So stay tuned for future events, and as always, feel free to reach us out if you'd like to dive deeper into any topics we covered today. So thanks again, and see you next time.
Thank you.
Thank you, everyone. Thank you so much.
Thank you.
Bye.
Bye-bye.
Bye-bye.
Bye-bye.